You ever look at a stock chart and it's just a squiggle, a total mess? It looks chaotic, right? So how in the world does anyone, from the big shots on Wall Street to folks trading on their phones, make any sense of it all? Well, that's exactly what we're going to get into.
So, if you want to predict where the market's going next, you've basically got two main schools of thought, two big camps. You've got one side that digs into what they call fundamental value, company earnings, economic reports, all that stuff. And then you've got the other side. They say, forget the spreadsheets. The real answer is in market psychology.
And that's the big split right there. Think of it like this. Fundamental analysis is all about studying the cause of what's happening. They're like detectives digging through economic data, earnings reports, the whole 9 yards. But technical analysis, and that's what we're focused on today, it studies the effect. The core belief here is that all that fundamental stuff, all the news, the hopes, the fears, it's already reflected or priced in to what you see on the chart. So if you can just read the chart, you're reading the market's final conclusion.
All right, so here's what we've got on tap. First, we're going to break down the philosophy behind all this. Then, we'll take a little trip back in time to meet the guy who started it all, a fellow named Charles Dow. After that, we'll get into the actual tools of the trade. And finally, we'll tackle that big looming question. Is any of this for real, or is it all just a fancy magic 8-ball?
Okay, so to really get what technical analysis, or charting as it's often called, is all about, you've got to understand its core philosophy. And it really all rests on three main ideas.
So let's just put a clear definition on it first. Technical analysis is basically the study of market action. You're looking at charts, mostly price and volume, to try and forecast where things are headed. The whole point is to listen to what the market itself is telling you, to figure out its next likely move.
And here are those three big premises. Number one, the market discounts everything. That means whatever price you see, it already includes all the known information. The good, the bad, all of it. It's all baked in. Number two, prices move in trends. They're not just bouncing around randomly. And number three, history repeats itself. Why? Because people repeat themselves. Human psychology doesn't change much, so the patterns driven by that psychology tend to pop up again and again. Just look at this chart of the S&P 500 over 20 years. I mean, does that look random to you? No way. It's got a clear direction. This really drives home that second point about trends. Chartists have a saying that's kind of like a law of physics. A trend in motion is more likely to stay in motion. It's way more likely to keep going than it is to just suddenly turn on a dime. All right, you absolutely cannot talk about technical analysis without tipping your hat to the OG, the guy who basically invented the field, Charles Dow. I mean, his ideas are over 100 years old, and they are still the foundation for everything we're talking about today. So this guy, Charles Dow, he co-founded Dow Jones and Company and was the very first editor of the Wall Street Journal. Now, what's interesting is he never actually sat down and wrote a book about his theories. Instead, he just wrote about them in his editorials. It was only after he passed away that someone collected all these writings, put them together, and boom, the legendary Dow Theory was born. And one of Dow's most amazing insights was this idea that the market is always moving in three trends at the same time. To explain it, he used this absolutely perfect analogy of the ocean. He said the primary trend is like the tide. It's the big long-term move that lasts for a year or more. Then you have the secondary trend, which is like the waves on that tide. Those last for a few weeks or months. And finally, you have the minor trends, which are just the little ripples on top of the waves, lasting maybe a few weeks. This leads to another one of his big ideas, confirmation. Dow said that for a big market trend to be the real deal, his two key indexes had to be on the same page. Those were the industrials and what was then called the rails, now the transports. And the logic, it's just common sense, right? If the industrial companies are making a bunch of stuff, then the transportation companies have to be shipping all that stuff. If they're not moving in lockstep, it's a huge red flag that something's not quite right with the trend. All right, enough with the philosophy. Let's get our hands dirty and look at the actual tools that chartists are using every single day to read these markets.
So, how do you even spot a trend? Honestly, it's way simpler than you might think. It all comes down to the peaks and the valleys, or the highs and the lows. An uptrend? That's just a series of higher highs and higher lows. And a downtrend? You guessed it, lower highs and lower lows. That's it. That's the basic definition.
Okay, now inside these trends, you've got two concepts that are absolutely crucial: support and resistance. The easiest way to think about them is this. Support is a price floor. It's a level where buyers tend to show up and say, nope, not going any lower. Resistance, on the other hand, is a price ceiling. That's where sellers step in and put a cap on how high things can go.
So you might be asking, where do these floors and ceilings even come from? Well, they're created by market memory. A previous low point on the chart becomes a potential support level because traders remember it. They think, hey, last time the price got down here, buyers came flooding in. And a previous peak becomes resistance for the same reason. Sellers remember, this is where the momentum died last time. The chart really is just a map of these key psychological battlegrounds.
But here's where it gets really interesting, kind of like a secret level in a video game. It's called role reversal. When a price smashes through a resistance level, that old ceiling, something amazing often happens. That old ceiling becomes the new floor. It flips, and this is a huge deal for chart readers because it's a powerful signal that the market's entire psychology about that price level has changed.
Okay, let's be real. Not everyone is a believer. Technical analysis has a ton of critics, especially in the academic world. And for decades, there's been this huge debate raging. Does reading charts actually work, or is it just financial astrology?
The biggest club that critics use to bash technical analysis is something called the random walk theory. It's pretty simple, really. Imagine you're flipping a coin. If it comes up heads 10 times in a row, what are the odds of it being heads on the 11th flip? Still 50-50, right? The past flips don't matter. Well, this theory says the stock market works the same way. Yesterday's price has absolutely zero influence on tomorrow's price. And if that's true, then looking at a chart is a complete waste of time. But then, you see a chart like this one for gold, and you have to ask yourself, if every day is just a random coin flip, how do you explain a clear grinding downtrend that lasts for 2 years? It kind of throws a wrench in the whole random walk idea. It suggests that, yeah, there might be some randomness day to day, but there are also powerful trends at play that you just can't ignore.
Okay, so here's another big criticism you'll hear all the time. It's the self-fulfilling prophecy argument. The idea is that these chart patterns don't actually predict anything. They only work because so many people see the same pattern, believe in it, and then all buy or sell at the same time, which, makes the pattern come true.
But there's a big hole in that theory. Chart reading is much more of an art than a science. I mean, you could show the exact same chart to 10 different traders, and you might get 10 different opinions on what to do. People are looking at different time frames, using different indicators, have different appetites for risk. The idea that all these millions of people are going to coordinate perfectly to make something happen, it doesn't really add up.
So what's the bottom line here? Look, technical analysis is not a crystal ball. Let's just get that out of the way. It is not going to tell you the future with perfect certainty. Nothing can. What it is designed to do is help you identify the most likely direction of the market and manage your risk. It's all about putting the odds a little more in your favor.
And I think this is the best way to think about it, a metaphor from the book this is all based on. A chart is a tool. That's it. It's like a scalpel. You give a scalpel to someone who has no idea what they're doing, they're probably going to hurt themselves. But in the hands of a skilled surgeon, it can save lives. It's the same thing with charts. In the right hands, they can be an incredibly powerful tool.
Because at the end of the day, that's all a chart is. It's a picture. It's a picture of human psychology in action, a live scorecard in the constant battle between fear and greed. So I'll leave you with this question. The next time you look at a stock chart, try not to just see a jagged line. Instead, ask yourself, what story is this picture telling me about all of our hopes and all of our fears right at this very moment?